Hello financial fans, welcome back to another stock analysis. Today we'll be covering the Coca Cola Company, stock ticker KO. The Coca Cola Company is a multinational beverage corporation that produces and sells a wide variety of non-alcoholic syrups and soft drinks. The company's most famous product is its flagship Coca Cola brand, which is one of the world's best-selling and most recognized soft drinks. The company also owns and markets other popular beverage brands such as Sprite, Fanta, and Minute Maid, as well as several energy drinks and sport drink brands. The company operates in more than 200 countries and sells over 1.9 billion servings of its products per day. They also have different bottling partners, licensing agreements, and joint ventures with other companies. The company's mission is to refresh the world, inspire moments of optimism and happiness, and create value and make a difference. They currently are sitting at a $262.9 billion market cap, and in 2021 they generated a revenue of $38.7 billion. The dividend yield is sitting at 2.89%, and they are a dividend king with their 60 years of consecutive dividend increases. 34% of their revenue is generated from North America, 17% from EMEA, which stands for Europe, Middle East, and Africa. 12% from Asia Pacific, 11% from Latin America, 7% from global ventures, and 19% from bottling investments. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has slightly gone up, going from $11.2 billion in 2012 to $11.4 billion in 2021. The average growth in EBIT during this period was only 0.44%, meaning a 5% increase in the margin of safety. Margin, however, has gone up with the falling revenue and the EBIT staying the same. It has gone from 23.3% in 2012 to 29.5% in 2021. The average growth was 2.8%, meaning a 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from $1.12 a share annually in 2013 to $1.76 a share annually in 2022. The average dividend growth was 5.2%, meaning no change in the margin of safety. The payout ratio is sitting at a relatively high 68.9% ratio, meaning no change in margin of safety just yet. Final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, you have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Coca Cola, this is just over 2 years. In this case, a 234% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital, however, is in a very nice 13.2%, meaning a 5% deduction from a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Coca Cola. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period for Coca Cola was 5.87%. I'm projecting a 6.5% growth rate for the next 10 years for Coca Cola and free cash flow. And with this percentage, we can determine the future free cash flow of Coca Cola and determine a terminal year valuation using a perpetual growth rate of 2.5% and a discount rate of 8%. Making these free cash flow the present value with this discount rate, we get a sum of free cash flow of $268.3 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with a $238.2 billion equity value. To get a discounted cash flow price per share, then we have to divide it by the shares outstanding, which for Coca-Cola is 4.3 billion shares. Doing this, we get a discounted cash flow price per share of $55.15, and with the current price of $60.81, we get a downside of $5.66, which is a 9.3% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was just over 3%, and I'm projecting an expected lifetime growth rate in dividends for Coca Cola of 3.5%. We'll once again be using a discount rate of 8% in this calculation once again. And out of this model then we get a discounted dividend model price per share of $40.48, and with the current price of $60.81 we get a downside of $20.33 out of this model, which is a 33% downside. The last model that we'll be using is the multiple valuation. In this model we'll be looking at similar companies to Coca Cola. We're going to look at their stock price and their earnings per share so we can determine the average PE multiple in the industry. In this case it's 32.47. All that's left to do then, get our fair value here, is to multiply it by the earnings per share that Coca-Cola is generating, which is $2.28 a share, leaving us with a fair value of $74.04, and with the current price of $60.81, we get an upside out of this model of $13.23, which is almost a 22% upside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we have imported the discounted cash flow, discounted dividend, and multiple valuation prices per share, leaving us with an average of $56.56. Our margin of safety we have determined earlier using a standard margin of safety of 25%, adding 5% for the EBIT growth, deducting 5% for the margin growth, deducting 5% for the return on invested capital, leaving us with a margin of safety of 20%. If we weren't to not apply this margin of safety, we would still get a downside of 7%, but let's do the margin of safety, and then we get a fair value applying this margin of safety of $45.24, and with the current price of $60.81 leaves us with a downside of almost 26%. So in this case it would be a sell, but since it's a company you want to hold for income and it's very stable with a big moat, it would be considered more so a hold in my opinion. If there's any other dividend companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.